Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Chris Vermeulen of thetechnicaltraders.com. Chris, how are you today?
I'm great, Robert. Pleasure to be on your show and excited to chat.
Really looking forward to this. And I think the best place to start, or a place I think would be good to start, is to go through any seasonal trends in the markets. And I'll put a bit of background on that. I had Ronnie Stuffley on the other day, and he was talking about seasonality in gold. But there's normally quite a bit of seasonality in things like the Dow Jones S&P, if I'm not mistaken. So dive into that if you can.
Sure. Yeah. Well, I can share my chart and show you some seasonality for more or less the stock market. So I like to look at the stock market. To me, the stock market is the SP 500. If you can track the SP 500, you can figure out what the other indexes are doing because the other indexes are all really, to me, the SP 500 is kind of the the broad market. I know it's tech heavy. People would argue that, but the Nasdaq is more tech heavy, and then you got the Dow Jones, which is more industrial kind of, and you got the small cap, the Russell 2000, which are big into banking and stuff. So the SP 500 to me is the key. And so if we look at this chart, and this is going back 30 years, on average, you can see the months across the bottom, what the SP 500 does, or the stock market in general, during those months. And we've always heard this saying, like, sell in May and go away. Usually after May, the market struggles and goes through summer doldrums. And then usually there's an October sell off. And then we go into the Christmas Santa Claus holiday rally. And so right now we've seen the market's been pushing higher. And here we are, December, kind of, it's December 10th as you and I are recording this. So we're kind of like right here. The markets are just starting to have a little bit of a pullback. This is perfectly normal. In fact, the markets have had a really nice run over the past couple of weeks to the upside. And a pause and a pullback is actually what we want, because if the market just goes straight up, what goes straight up usually comes straight back down. And so we want that stair stepping price action. And so that's where we are. We're in a little bit of a doldrum right now, a little bit of a hiccup in the stock market in general. And then we should start to see things push higher right into the end of the year. So that's what I look for, the whole broad stock market. I kind of the way I look at the stock market and investing is, I think, probably a lot different than a lot of people, or this is a good analogy, is I'm a surfer. I live on the water. I look at the stock market as like kind of like the ocean. When you go to the ocean, when the tide goes up, it lifts all boats. When the tide goes down, all boats go down. The stock market is the same. When the SP 500 is going up, it's lifting most stocks. When it's going down, most stocks are going down. And so you want to make sure you're in favor with that. And then every year there's going to be 5 to 12 waves that roll through the market, just like a surfer. If you can walk down a beach in Florida or somewhere, and there's surfers out floating past the break, they're sitting there floating, waiting for what? They're waiting for those next set of waves to roll in. And so that's what I do, is I sit back and we wait for these waves, which you can somewhat see on the seasonality chart. And when you see these waves, you can see the waves coming because they're bigger than normal. There's momentum behind them. And once they get close enough, you pick the one that fits your criteria, your position in the water, or your risk tolerance as a trader. And then you hop on that asset or that sector or whatever it is, and then ride that. So that's how I look at the market. And seasonality shows, it shows we have huge waves like this rally up into March, or sorry, into May, and then a big wave down. And then we have a big, strong wave to the end of the year. Plus, we have these smaller waves in between. So when you look at the market, you break it down from a rising tide, falling tide environment, and then break it down to these waves. You can really take advantage of the market and have a good feeling for it. So that's where I see the stock market. And then seasonality, you want to maybe touch on commodities. Gold is another one where gold has had a pause over the past couple of weeks, and it's just starting to come to life right now as we're recording this. And gold should rally higher into the end of the year as well. There's a lot of things in favor for gold in terms of where we are in the major super cycle for gold, for the economy. So that's where I see seasonality wise for these two major kind of assets.
And then, Chris, because I know that people will be thinking about the first month or two of next year, January and February. So how does that? Obviously, I appreciate you've just gone up to December there with the S&P and gold. And what does the generic trend look like in the first couple of months of the year? Is it favourable, or does that then start to possibly take a turn in the other direction?
Yeah, January is going to be really interesting, especially for like the SP 500. Like if January closes positive, then we tend to have a positive year. If it closes negative for the month, we tend to have kind of a negative year, lower stock market. So January is kind of giving us a barometer. We kind of have to let that unfold. January is usually a choppy time. And the reason is simply because look from October, we have this huge rally into the end of the year. And when you have a big rally, there are some pullbacks along the way, but after this rally, this last push, what do we need after that? We need a pause and a pullback. And so January is that pause and pullback before it has another leg up and then another pause and then another leg up. We want that stair stepping price action. So expect January to be choppy. We got Trump, inauguration in January. We got the Trump tariffs that are going to like whack all kinds of sectors and industries and countries and importing and stuff that's going to shake things up. So I'm expecting January to be pretty gnarly and volatile, and it's probably going to really hurt the semiconductor space, which are heavyweights in this market. And if they get hit, the whole market's going down because this market has really been rising and lifting on the backs of like AI and technology and semiconductors. So I expect 2025 to be pretty volatile in terms of the stock market. For gold, we see the same thing. In December, it has a very strong run up. After a run up, you need some type of pause and hiccup, and it has that. And then it wants to push higher into February. And then gold's kind of out of favor really until September. It really kind of falls out of favor, which I kind of think is actually going to happen this time around. I feel like the stock market is going to want to top in January, February. And when it does top, it's going to pull everything down with it, including commodities. So it actually will bode very well with what naturally happens in gold, which is kind of down and to the right after February.
You actually just beat me to my next question because I was going to ask you what you think your outlook for next year is. Okay, going back to what you've just said, then, if you're able to put some from your analysis and what you're seeing, let's try and put some numbers on this. So, what when you say the S&P tops, what sort of number are you looking for? And do the same with gold if you can.
To put in a top for this year or a market top, I think the
For
stock market could,
2025.
yeah, I think the stock market might it's really tough to figure out where it's going to put in top, but I do feel like we're going to see the stock market pull back a bit, and I do think we're going to see it push up another maybe 2 to 5% to the upside. We could have a really nice push come the end of the year, and I think it's going to suck a lot of investors in. They're going to pile in because we are seeing money. The average investor is getting really aggressive. They're moving into all the ARK ETFs, which are all the small, super high growth, volatile stocks. They're moving into Bitcoin. They're moving into blockchain sector, all of that stuff. And when everybody piles into the really aggressive stuff, it's usually the last herd mentality. They all have FOMO. They want to get in. And so that's where I believe we are, which means the stock market doesn't have a whole lot of upside left. So I'm thinking 2 to 5% to the upside by the end of the year. January will probably be really choppy. And then the question is, does it put in some type of top and then maybe go into a much deeper correction, like a financial reset, which could get pretty ugly next year. So I'm not looking, I don't think anybody should expect to the moon returns to the end of the year. Just expect the markets to probably want to go slightly higher. When we look at gold, kind of the same scenario. We're just seeing gold start to come to life. We had some fear in the market 2 days ago, uh, and we saw the VIX pop 11%, and people got out of the aggressive stocks and they moved into gold and silver and miners. And so this just confirms where we are in this overall massive stage in the stock bull market cycle is gold has been doing very well. And as soon as there's a little bit of fear, people move into gold. So I believe gold is going to continue to move higher. I think it's going to push to some nominal new highs, 28, 2850, 2900. I think it will grind a little bit higher. I don't think there's huge returns, but I do think it's going to be a very low risk investment. I think it's going to, at worst, go sideways. At best, rally, roughly 4 or 5% to the upside, maybe a little bit higher. So it's not earth shattering returns, but it should continue to move up and have very limited downside risk. I think we did hit a major target on gold at 2750, which is why we have this big bout of selling. That was projected from all the way back in 2001, more or less. And so we've hit that target. We actually sold some of our gold position, or all of our gold position, with an ETF right up here. And now we got to let gold figure out what it's going to do next. But expect the precious metal space to grind higher into the end of the year in January. As things get volatile in January and the stock market maybe starts to pull back or go sideways, I think gold will continue to push higher as money comes out of stocks and they go into gold, which is seen technically, like just right now, as a defensive play.
A thing to add on that for those that are listening to this on podcast format, Chris is going through his screen at the same time. So again, what we'll do is I'll put a video in the Substack post. For those that are listening to this that want to see the visual charts, you can do so. Head over to YouTube, or I'll put it in the link as well. Okay, so that's an outlook up until January, and you've mentioned as well. Obviously, Trump inauguration happens in January. Proposals of tariffs as well. Have you seen anything to indicate that the markets could just completely blow up next year, as in it gets too frothy, and then if there's a sell-off, I mean, that could be,
Mhm.
people talking crash as big as 1929. Other people are saying, S&P, up to 7,000. I'm holding my hands up. I'm none the wiser. What do you have any specific thoughts on that at all, Chris?
Yeah. So, I mean, the markets, when we look at the markets, I think there's a lot of things coming into play. I think um, when we look at the overall larger cycle of the stock market, generally we see gold come to life and outperform stocks. We tend to see energy stocks outperform the market and trade higher. Both of those we're seeing. In fact, the crazy part is there's a huge disconnect in the energy space right now, which is oil is way down. It is bouncing on support, about to break down through it, and I think drop dramatically. I think oil could be like 60 or $55 a barrel very quickly. Yet energy stocks are trading near all-time highs. Everybody's positioned in energy stocks expecting World War III and chaos, and they're all saying for $200 a barrel oil. Yet oil is going the opposite direction, and it is about to fall through the floor. And and the fact that people are in energy stocks expecting war, they're worried, and oil to go higher, and they're loaded up in gold is a huge warning sign of the major cycle that's coming to play. And that is kind of one of the early warning signs. And it takes months to unfold. And we've been doing this for months now, and it's getting closer and closer. The other aspect is the sentiment of individuals. We're actually getting very close to what we saw back in 2001, where everybody had this big euphoric kind of rally where everybody piled into all the aggressive sectors. And of course, they all piled in right near the top. And I believe we're kind of in this complacency move where uh, you wouldn't know it from the SP 500 and the Dow and really the Nasdaq, because the big technology stocks have muscled those indexes higher. They've been drifting up, but the majority of stocks, if you look at the equal weighted SP 500, you look at the small caps, the micro caps, they're really struggling. They're not making new all-time highs. Yet the indexes make everybody think that the stocks are going up in general. And this is a big disconnect a lot of people see with their portfolios. People who are buying all kinds of individual stocks, their accounts are down, yet the indexes are making new all-time highs and they don't get it. And that's because the indexes are heavily weighted in like 10 stocks and or seven, you could say the Magnificent Seven. And it's been dragging the indexes up, yet all of their other stocks aren't floundering. And right now we're seeing people get excited about the market. The VIX is down, which means there's not much fear, and they're piling into the growth stocks. And this is usually what happens is complacency move just before the market tops and rolls over and sells off, and we go into this anxiety and denial phase and more or less a bear market. It's considered a stage four decline in the stock market. It's if anybody's ever read Stan Weinstein's book, How to Profit from Bull and Bear Markets, he's where I came up with this, learned this about four stages. And stage four is like the financial crisis of 2008. It's like the tech bubble bursting. It is a bear market, a financial crash, financial reset, whatever you want to call it. It is life changing, and it's a reset across assets and people's lives who don't know how to spot them and benefit from them, or at least just avoid them and sidestep them. Um, so there's a lot of things brewing, big things brewing that are telling us the signs are there. It's just a matter of like, when does the music stop and things start to drop? I think 2025 is going to be the year. I feel like we're inching closer and closer to the tipping point. But the stock market trend is still up, and we're long stocks, and you really do need to be long equities at this point until they actually turn around and prove that, hey, they're not in an uptrend anymore. Let's get out and go somewhere else.
That's fantastic. I'm smiling like a Cheshire cat. 'Cause I'm looking at again, looking at the screen, looking at stage 2, 3, 4, and I would imagine we are what, near the end of stage 2 there, nearly up to stage 3. Would you say that's about right?
Yeah, I believe we're right at the end of a stage three now, and this is why I said the indexes are skewed, because the indexes are showing we're like at all-time highs, but the majority of stocks are actually just trading sideways in this sideways pause, and that's where there's like people. The market is great at camouflaging what's actually really happening. So the indexes make you think we're at the end of a stage two, but we're actually at the end of a stage three when you look under the hood and be like, all the stuff that's going on, you're like, holy crap, this engine's about to blow. We're actually right at the end of a stage three, and it's going to be lights out here soon for people. And that's what the market is great at, is thinking you're not where you are in these stages. It's making people think we're at the end of stage two, but I believe we're at the end of stage three.
Fair enough. In terms of, you mentioned oil actually. Before we get onto oil, it's probably prudent just to quickly go over silver if we can. Because again, when I'm reading online and I'm going around, I'm seeing people saying that silver might go down quite considerably, then might jump up. Other people are saying, well, it could be 50 or 60, and then a big recession hits and it drops down. Any thoughts before we get to oil? Any thoughts on silver and what you see happening or what's likely to happen moving forward?
Yeah, I think silver is going to be. I think gold, silver, and miners all have the same thing kind of going on for the till the end of January, which I think is going to be. They're all going to go up to the recent highs. They've all pulled back in the last month, but I think they're going to move higher and retest those highs over the next month or two as those kind of defensive plays. When people get nervous, and as we get more and more nervous in the stock market, more people are going to move to gold and silver. We have seen silver move all the way up to more or less its measured move based on Fibonacci on some technical levels. It tagged it 2.5 months ago and then quickly pulled back. Gold did the exact same thing, which I didn't show it on the gold on a gold chart, but if you were to look back at the long-term target price using Fibonacci extension for gold on the monthly chart, gold came all the way up and hit its measured move, and now it's stuck there. So silver and gold have both hit their 100% measured moves from way back in time, and I think they're going to go back up and retest those and poke through them. But silver's got this major resistance area between 35 and about this other candle high that we saw back in 2012, all the way to about 37.50. So somewhere in that range, silver might push up and get higher. Percentage wise, it's pretty good for silver. Silver is volatile. It could move potentially 10 to 15% almost. So there is some upside, but I believe it's more so a trade. If you can catch that move and lock in some gains, great. But I do think it's going to eventually stall out and sell off. During the tech, or not the tech, during the 2008 financial crisis, silver pulled back, 60%, over 60%. So it is very volatile. It's a tiny market. When people start to panic, silver just falls and just goes into a waterfall sell-off. Gold sold off 34%. Platinum sold off 65%. Real estate REITs sold off over 65%. There is no safe haven when the tide is going down. Almost all assets go down during a recession, and that's where my whole strategy. I have a strategy I call asset revesting. It's all about not holding assets that are going down and find an asset going up, And that's like the key. The problem is people diversify and they hold a whole bunch of different things saying, hey, I got gold, I got tech, I got real estate. What they don't understand is when the tide goes down, they all get wiped out. It's just some don't fall as fast as others. And that's the huge disconnect. Diversification is a great way to lose a ton of wealth and really screw over your retirement. There is no protection with diversification. You're just spreading it out over more stuff, and they're all going to go down. All boats go down with the tide. So, anyway, back to silver. 35 to 37.50 has the upside, maybe 15% going into the end of January. But after that, I do think we're going to see it have a pretty big correction. Who knows how much it could pull back from there? I think we could see it pull back down into potentially the 24 range, like a 35% pullback, where there's going to be a lot of support from earlier in 2020 all the way to kind of where we are now. So I do think it'll get hit. I think gold will pull back 15 to 25% as well. But again, there's upside. It is a trade going into the end of the year, end of January to the upside.
Fair enough. And for those watching the video, is it possible just to do a percentage swing between that low there in 2008 and then that high in what I think is 2010, just to show that percentage gain?
Yeah, that was a
Wow.
almost a 500% gain. And that's the type of move I believe is going to happen
Hmm.
once we have this financial reset. Everything is setting up very similar to 2008 and kind of a hybrid of what happened in 2000. I think we're going to see everything pull back over the next year. And once gold and silver bottom and everything else bottoms, we're going to see the precious metal space come to life. And they typically come to life before the economy and before the stock market, the stock index is bottom. And so that'll be an early warning sign. And once we do, I mean, I think we're going to see silver it'll hit $50. It'll blast up to probably like 80 or 100 and change. It has tons of upside potential, but it's not a straight line. And I think we're going to have a big pullback before that. And that pullback is going to be kind of that last opportunity before that 2008 rocket ship type of move where it can rally, 3, 4, 500% very quickly. That time will come again. It's just a matter of being patient and knowing where we are in these cycles and letting them unfold. These are, we're looking at monthly charts here, which a lot of people probably can't see, but this is going to take, 3 or 4 years to unfold. I think we have a year down or so, and then it's going to take 3 or 4 years of continuous rallying to the upside to reach these levels. So it's not going to be, flash in a pan. You got huge returns. It's going to take, these are long-term trends that will unfold, but they will be definitely life-changing and exciting.
No, absolutely. I'm looking forward to it personally. I think that goes hand in hand because I've had a few discussions recently between the mentality you need as a trader and as, for example, if you own physical bullion. So if I own physical bullion, if silver pops up to 37, call it, drops down to 24, and then in 5 years' time is, let's just say it's $100 for argument's sake, I'm sleeping well at night regardless. If I'm trading silver, then this is where, again, these graphs, this information is critical because, like you said, it's very easy to get wiped out if you're making the wrong move at the wrong time.
Yeah.
Chris, you mentioned oil a bit earlier on and the fact that you believe that it is on a downward trajectory. Can you just go into that a little bit before? Can you please just go into that a little bit more for me, please?
Yeah, sure. So if we take a look at oil, and people are thinking you go all the way back to 2005, and I was to draw a line right through the middle of all the price action, all the way through, it's around 66, $67 a barrel. And if you picture that line straight across the screen, and then if you took a rubber band and you stretched it up and then let it go, it's going to like go back and forth among that medium, that center line, right? And so oil has been pivoting above and below that. Right now, we have been seeing it just constantly hitting this support level around that $66 mark. Even more so when we look at the daily chart, it's just constantly just hitting on this level. And every time it hits $66, it's eating away. There's people there buying oil and holding support. But when those buyers are done, they're like, I got all I can take. I can't hold anymore. I don't want anymore. We're going to eat through that support. and oil is going to fall. And we're going to see a pretty dramatic collapse in price. And I think oil could fall down to 60 and even 50 or even 45. And people are probably thinking, well, that's pretty crazy. But if you look at these levels, we've seen the $52 per barrel mark hit so many times, like probably 10 times or so in the last 15, 20 years. And we've seen it go even lower. We've seen it go negative. So anything is possible. The chart is pointing to about $40 per barrel during probably the peak of the recession, whenever that happens. And it'll be a short-term move probably, but there's a lot of downside in oil. And the crazy part is oil has been going down for several years already, since the peak in 2022. And then if we flip the scenario to the stocks around the energy space, we look at like XLE. Every time XLE has gotten up to these nosebleed territories, we've seen a major market correction. And XLE is right where it was in 2008 before it crashed dramatically. The energy sector space fell about almost 60%. We've seen it have multiple waves of 50% during other weak economic times. And energy stocks right now are on the verge of making new all-time highs, yet oil and natural gas are fairly low, and oil looks like it is about to drop. And so to me, the average trader is like leveraged into energy stocks, anticipating oil to skyrocket. And if everybody's already crowded in the oil trade and there's really not a whole lot more buyers because they're all anticipating, they're already ready for oil to rally. But if oil breaks down, they're all going to have to get out of this position. And there's a lot of pivot lows on the chart. Wherever we've seen these lower lows on the chart, each one of them is going to be a layer where a certain group of people are going to put stops. And the way that oil energy stocks have moved up has created multiple layers. So when oil breaks down, and if it does, the energy sector space is going to get wiped out. We're probably going to see another huge reset, potentially XLE down to about $40 as well. Same as oil. And it's going to be like a 50+% unwinding event in that area. So that's where there's this huge disconnect where oil looks so weak and it doesn't look good at all. Yet energy stocks have this really bullish chart pattern and everybody's piled into it. And the interesting thing with the energy stocks is we've had strong money move into energy stocks back from 2020 all the way to 2022. And then what we've seen is energy stocks continue to make higher highs, yet the volume continues to dry up. So it's going higher. There's not many buyers left because everybody's gotten in. There's not a whole lot of power behind it. And then once it starts to fall, everybody's going to want to get out of that position. And it's going to me, I think the big opportunity in energy is actually to the downside, especially in energy stocks. I think percentage wise, they're going to get hit. And that'll, we're all we need, I think, is one piece of bad economic data to roll out in any country, and it's going to trigger oil to break down through that 66 level, and then it's going to be like lights out for energy stocks. I have people right now, I just got a couple emails this morning saying, Chris, why did the energy sector like XLE crash so hard in the last week or so? And I find it funny because I'm like, well, it hasn't crashed yet. It's just having a little pullback. It's still in a long-term uptrend. You don't know what a crash is until one really happens, but it's good. Things are going to get really ugly. And I think the market we're starting to see that. We're starting to see some heavy volume selling in the energy space. When you look at the intraday and the daily charts, some big money players are starting to unload their energy stocks because I think they see weakness for oil coming, and they're like, we better get out of this, lock our gains in while energy stocks are high, because there's going to be a reset.
I know that there'll be some people listening to this with regards to oil that say that oil could potentially go down as well because, again, the impact of Trump tariffs and so forth. Is that something that you would say just adds to your oil thesis, or is it just this is what the graph's telling me? I mean, I can clearly see that's getting weaker, but would you say that drill baby drill has any impact on that, or it's just part of recession 2025? Likely, this is what normally happens.
I think there's definitely Trump saying, "Hey, we got enough oil in the ground here. Why bring it in from overseas?" I think that opens up the floodgates for more oil, which definitely I don't think helps oil. If anything, it's probably helping apply downward pressure. I think someone's trying to hold and support the price of oil, but when they once they get broken, they can't support it and it breaks, oil's going down. But I think there's for sure the whole talk of Trump and oil, in North America is putting extra pressure. People are selling oil because they're like, hey, there's going to be tons of it available. We can get it right here. So that is most likely adding to the downward pressure. But in the grand scheme of things, um, oil and what energy stocks are doing is very similar to, I think, what happens during full economic and stock market cycles. We saw oil have a huge skyrocketing move just before 2008. And that financial crisis unfolded very quickly with banks and bankruptcies. We have had that huge rally in oil back in 2022, and the Fed and everybody's kicking the can down the road, trying to keep the markets alive with all kinds of different plans, stimulus and things like that. So it's dragged out a little longer, but we have that scenario unfolding in terms of the energy space, giving us a warning sign that it's already blown off and had a huge move in 2022. The energy stocks are now primed and ready, telling us the sentiment is completely out of whack, and they're all on the wrong side. And there's going to be a big unwinding event. In fact, very similar to what we have going now in the energy space, is when we look at energy stocks, is similar to what oil did from 2010 all the way to 2014. It kind of just keeps grinding higher lows and has all kinds of pivot lows layered in. And once those lows start to break, and it's a long time of people accumulating oil, it turns into a huge waterfall sell-off. And I think that is the price action we're going to see in energy mining or energy stocks. Is it's the charts are set up for an epic waterfall crash, and people are going to be scratching their heads going, holy crap, why am I holding energy stocks when I could lose this much? And people are in energy stocks because they pay nice dividends. And people think they're safe, but even dividend stocks, aristocrat stocks, the big blue chips. Oh man, the financial industry is so backwards. The 60/40 portfolio is like guaranteed, you're going to ruin and blow up your retirement. People who are diversified into all the dividend paying stocks, look during COVID, the dividend ETFs, the highest dividend stocks, and those sector ETFs that focus on just holding all the high dividend, they fell more percentage wise than the stock market because all the same people, all the older, richer people have the same positions because that's what their advisors put them in. And when they all hit the breaking point, they're like, I can't take this anymore. My retirement's vaporizing. They all sell their position, which are all the big blue chips, and they sold off even more than the stock market. Dividend stocks are going to be the death of so many retirees when the market cracks, and they're going to be all so they could get a little bit of an extra, yield where they could sit in cash right now and get 4.5% safely, or they go into an energy or high dividend fund so they get 6 or 7%, but they're going to lose 50% of their account when the market blows up. And people don't weigh the risk. They're like, oh, I'll make an extra 2% over, the interest rates, but they don't realize, well, I'm also going to like lose half of my wealth in an 8-month window when the market implodes. And it's going to happen so fast that they end up being down so much that they're like, I can't get out now. I can't book these losses. And then they hold it, and then the markets keep going. And I mean, this is what I'm trying to stop people or prevent people from running into is I believe right now, um, the markets, there's more people close to retirement and in retirement right now. The markets have a way of hurting the most people. And those are the most people. We're going to see, I think, retirees get hit the hardest because they all have the same strategy, has no real risk management in place. And you need to be able to know that when these markets do start to turn around, you need to get out of them or you're going to like wipe out half of your life savings and completely have to downgrade, your retirement, all because of a lack of risk management and having technical skills to identify when a trend turns down. You don't want to be holding that asset. That was a little bit of a rant off, but this is the danger is people are loaded in these energy and dividend stocks, and they're going to be hit harder than, you know, probably the indexes or the same. There's no safety in them.
Thanks for that explanation. That was part of the reason for having you on as well, Chris. Listening to yourself on other podcasts recently, and touching upon the same subject. That was one of the reasons to have you on this. To point that out. Just a book recommendation actually for people listening before we start to wrap up. I just finished reading Benjamin Roth's A Great Depression, a diary of the Great Depression back in no, it starts with the 1929 crash and goes through. Highly recommend you read that book because it is, I wouldn't say it's mind-boggling, but this is a regular guy who had a diary basically throughout the 30s. And what you just said hit me a little bit, where you would have had people that the market takes a turn down and people continue to hold and continue to hold. And he comes up with, there's so many examples in that book of people speaking to him on that. So that's a book recommendation. Always a realist on this show. There's always a bunch of ways to make a bunch of cash when the market turns south. So let's go into that. We're talking about something potentially bad happening in 2025, but of course, strike while the iron's hot. So what would you be doing, or what have you and your clients started doing for the next year, Chris?
Yeah. So when the stock market does turn down and we're confirmed that we're in a stage 4 decline, which is a financial reset, uh, then there's a few ways that it can be played. I think there's three great ways to do it. First is, I think bonds like TLT, the long-term treasury bond, I think rates will eventually get cut. And I think bonds will do very well. They're very low. The charts look really bullish. They're trying to put in a bottom. The bottom's not fully formed yet, but I think bonds will do well. It really is there's gonna be a bit of a wild card with Trump and his tariffs. If the tariffs like jack up, inflation's going to stay high. They might not cut rates very much. So that might limit the bond trade, but I do like bonds longer term. The other one is the US dollar index. I think holding the US dollar or playing the US dollar index itself is going to have a lot of upside. I think it's a fairly slow moving asset, but you can put a lot of money, you can put all your money into it. I'm fully invested in the US dollar because I think the dollar has got a long ways to go to the upside. Typically, it's one of those assets that can rally and when the markets and the economies are falling apart. The dollar tends to always scream higher in 2000 tech bubble, 2008, all of those significant resets, people move to the dollar. It's still the reserve currency and it goes up when there's fear. We're actually seeing that this week. We had a little bout of fear in the VIX and people dumped stocks. They moved into gold and the dollar. They both moved up. So the dollar is a very powerful play. The other way is with my strategy, we also will move over to inverse ETFs. So every time the market, has a bounce and rallies up, and then once that trend turns over and starts another down leg, we'll buy an inverse ETF. So as the market falls, the ETF goes up in value. So we take advantage of either moving to a different asset class, which is bonds or the dollar, or we benefit from falling pricing in the stock market. And so that's how you have to go about doing it. Those are really the three kind of best ways that I've found to take advantage of it. They're all three different asset classes. You've got stocks, inverse stock market, you've got a currency, and you've got bonds. And so they can all move on their own. They're their own beast, and they're not all related together. A lot of people will want to get into different stocks. In general, if the stock market's going down, don't try to pick a sector you think that's going to go up. Just play the falling tide, like benefit from an index, play an inverse index ETF, let the tide go down and profit from it. Don't get fancy trying to, everybody always has to get fancy and play all kinds of stuff, but it generally backfires in the long run. It's so that's how we're going to play the downside once it kicks in.
Fantastic. Thanks for sharing that. Because again, it's always, always like to be offering solutions and ideas for people to think about, because you might as well profit both ways while you can. Chris, if people want to get hold of you, get in touch with you, how do people find you?
Yeah, they can find me. They could go to YouTube and just type in The Technical Traders. They could go to my website, which is thetechnicaltraders.com. They can check my book. If you go to Amazon anywhere, I've got a book called Asset Revesting, which is exactly kind of what I just shared with you, how we ride the markets up and how we can profit from falling markets by reinvesting in a different asset. So it's called Asset Revesting on Amazon or Chapters or wherever you want to go. But that's how they can get a hold of me, and email me from our website if they've got any questions. And what I do with my service is I share the trades that I do with my portfolio with everyone, my portfolio allocation. So you literally just copy what I do. I shadow the markets, you shadow me, and I share my videos and analysis and thoughts. And so it's really educational. Plus, you kind of just get to ride the coattails of what I'm doing.
Fantastic. And for those that are viewing this through Substack, I'll have all those links in the Substack post as well. Chris, it'd be fantastic to catch up in 2025 and see maybe the middle of the year, see what the state of play is. So if you're up for that, I'm up for that.
Sounds great. Yeah, it'd be a pleasure.
Well, fantastic. Let's see what happens. Chris, thank you very much for your time. Have a fantastic festive period and look forward to catching up next year.
Thanks, Robert. All right, take care. Bye bye.